Right. Well, good morning to you all, and thank you very much for joining us in our latest workshop in our business support program. And today's focus is all about taking those first steps to investing in the stock market. And for those of you who don't know me, my name is Sarah Austin. I'm the founder of the Really Helpful Club. Also delighted to introduce you to Caroline Edwards. Caroline, as many of you will know, is our events director. And then Rowan Gerard and Francesca Ashby-Rudd, who run Really Helpful Club in Surrey, Sussex and Hampshire. We'll put all of our contact details into the chat so you can contact us if you'd like to during the course of today or afterwards. Now, for those of you who are not familiar with Really Helpful Club, I thought it would be helpful if we gave you some background as to who we are and what our community is all about before we introduce you to today's speaker. And our team each come from professional corporate backgrounds. I was a senior fund manager in the city, Caroline was a leading barrister, and Rowan and Francesca both had successful careers in PR. And we've each taken career breaks, and we're now on our journey together, building this vibrant and fast-growing community. Now, as many of you will know, Really Helpful Club is an online network that brings together positive and like-minded people to help and connect one another in our personal and our business lives. And we're founded on an ethos of shared advice, trusted recommendations, and a caring community. We are the go-to portal for solutions in every aspect of your life, from your health and your family to your career and your business needs. And everything we do is about word of mouth and the power of networks. This is a high-quality community that attracts positive thinking, like-minded people whose recommendations you can rely on, people that you can trust. It's free to be a member, and with over 15,000 members, we are buzzing. Now, in the last year, we have come to rely on virtual contacts, online connections, and a trusted community. We have come into our own. And since the first lockdown, we've moved our highly successful events program online, and we have an exciting lineup of events in the coming weeks and months. And what this has allowed us to do is to extend our reach. And in this vein, there's been so much demand to join our network that we have now launched into Surrey, Sussex and Hampshire with our dedicated team who is based down there. And the response has been extraordinary. And we have 5 more talks and workshops coming in the next 3 months. So please make sure you visit the website regularly, look out for our newsletters, and contact Caroline about our events program. And if there's any talk that you've missed, which you would like to catch up on through a recording, again, please contact Caroline and she'll be delighted to talk to you about getting that to you. Now, today's talk has been given by Elizabeth Pearson. Elizabeth is the founder of Simple Successful Stocks. Love the name of your business, Elizabeth. It tells you what it does. And Elizabeth helps women who are wanting to understand money and get it working for them, but don't know where to start or who to trust. And she gives them the knowledge and the confidence to invest in the stock market themselves and take charge of their financial future, make it simple, jargon-free, and full of sparkle. Now, Elizabeth started investing while working as an architect, but she just thought there had to be a better way of earning a living. And I will leave you to hear more from her a little bit later about how that journey's taken her. Now, just before I hand over to Elizabeth, I'd like to give you a little bit of guidance about housekeeping, format, and timings. The session will last about an hour and a half, stopping about 12. This will be very relaxed, very interactive. When Elizabeth is speaking, can we please ask you to mute your screens? Sounds like we need 1 or 2 of you to mute your screens now. And this way we just cut out all that interference, which makes it very difficult for everyone else if there's any other noise. But what we'd ask you to do is do pop any questions that you have or any comments into the chat box. Caroline will collate these as we go along, and we'll have various points along the way where Elizabeth will pause and she can answer these. And what we'd say to you is that some of you will have taken some steps into investing. Share those if you'd like to do that. Share some of your experiences, share some of your thoughts. This is how we get it to be interactive, and this is how we learn from others as we go along the way. Now, as I said to you before, we record all of our talks and we make those available to you, but this is on the proviso that we will register everyone as members of Really Help the Club and also to the newsletter with simple, successful stocks. Now, remember, you can always unsubscribe to those newsletters if you wish to do so. And if any of you don't want to be registered, then please just contact Caroline directly by email. I'm also going to pop a link into the chat box as well. So if you're not already registered, then you can instantly become a member of Really Help the Club. And so please then fill in the Join Us form, and then you'll receive an email to verify that registration, and then you'll instantly be part of our vibrant and fast-growing community. Now, with that, I'd like to hand over to Elizabeth. I'll stop sharing. And remember, please do pop any questions, any comments you have into the chat box. This is a very safe space and is for you to enjoy and get as much out of it as possible. Thank you.
Well, hello everybody. Hello, and welcome to today's session with the Really Helpful Club. It's thank you so much, Caroline and Sarah, for inviting me. Thank you so much for coming. The purpose of today's class is to give you an overview of what investing is, the reasons for doing it, when a good time to do it is, and how to start. So I'll introduce myself in a little bit and talk for about an hour, and then there's plenty of time at the end for questions. And I may just kind of spice things up a bit by asking if anyone has any questions in between. And then just at the end, I'll talk a little bit, if it's okay with you, just for 5 minutes about how you can, if you want to, work with me further. But if that's not for you, please go off and have a cup of tea and come back. So now I'm hoping some of you may have some notes to hand. If you've got a link to some handy notes, yes, there should have been something. Brilliant. Okay, so this is great. Now I am offering a prize. So if you answer the notes correctly, email them to me. You can photograph them and send them in. Then I'm offering you a copy of this book. It's a very good book about money and wealth called The Wealth Chef by Anne Wilson. So first set of correct answers, and then I'll send you a prize in the post. So we are here, let me just do a share screen to talk about investing. Now, money is not something that we talk about that much. We all have our own experience and relationship to money, which we learn about from our environment, our experience, our habits, the things that people tell us. Now, a report from the Lloyds Banking Group last year described the M word as actually Britain's greatest taboo. Apparently, we Brits talk less about money than we do about religion, politics, or even sex. So people have many fears and misconceptions about money and also about investing. And this is absolutely understandable because we're not taught anything about it at school. So a lot of my clients really feel bad about themselves or guilty because they don't know this stuff. They haven't started earlier. Why didn't I do this before? But that's not our fault. You know, we're not taught anything about it. And often as women, we're not moving in environments where it's talked about. So these are the common fears about investing, and you may or may not relate to some of them. And these really get in the way of us starting on our sort of investing journey. So one of them is that you need pots of cash to start investing. You need lots of money. The second is you need piles of time to do it. The third is that you need to be from the city, have a financial background or degree. The fourth one, you have to be good with numbers. And the fifth one is it's risky and you'll lose everything. So over the course of this hour, you'll see that a lot of those things aren't true. But what's great is that you're here in the first place. So I think it's important that you acknowledge yourself. You've taken this step to educate yourself and find out more about money and investing. So how can I change this? Oh yes, here I am. So just to say a little bit about myself, I am Elizabeth. My name's Elizabeth Pearson. I didn't start my life as a financial educator, which I now call myself. I actually trained as an architect. It wasn't something that I really enjoyed, and I started investing in 2006. Not really because it wasn't about the money. It was actually coming out of a self-development course that I did, which I realized that it was really important to make my relationship with my dad better. And he taught himself to invest. And I thought that if I learned something that he had taught me, if I could learn something, he could teach me something, that would be really good for our like dad-daughter relationship. Give us something to talk about, which it actually has. It's been absolutely brilliant. And so I began investing. You know, he didn't tell me what to do, he told me how to go about it. And I started doing a little bit, you know, alongside my job, not a huge amount of time. You know, I was a busy woman. And it turned out in a way that because I was not, I don't know, I didn't take the results personally, that made me a really successful investor, because I would follow a set of instructions and then not be attached to the result. And as my sort of life and work progressed, I had some time in between jobs, and then a friend of mine said to me, well, why don't you start a class teaching people what you know? So that's what I did. I had some friends around as my guinea pigs. I had a good time. And so here I am, you know, 5 or 6 or 7 years later. And I think what I've experienced, which I want to give people, is how investing can be simple. It doesn't need to take a long time, but also to have an experience of wealth growing independently of your time. And that is something I've experienced myself. I've seen that how money can grow at a relatively small amount of input from me relative to the wealth that I've created. So that's what I hope that you'll, you know, get to experience as an investor. So how can I change? So I just have to say a disclaimer, first of all. As I said, I'm a financial educator. I'm not an advisor. I'm not a planner. So my purpose is to give you the knowledge and the confidence to do financial steps for yourself, to empower yourself and the people around you as well. So what is investing? Investing is basically about creating things called assets. And these are things which create wealth for you, either in terms of an income or growing in value, or both. So stocks and shares are one example of an asset, but you can also have things like wine, jewelry, property. You know, they're all assets. Now, investing is very different from saving, and people often get this confused. So saving is where you're putting your money aside with the intention that you will spend it later on. You know, this could be a holiday, or it could be a car, or it could be a course that you want to do. But what you're doing in investing is you're putting your money into an asset and you're building wealth in the long term. So, and you're buying stocks and shares, and you're buying and holding them so that they grow in value, enhanced by this, what I call it, the magic of compounding. So when you own a stock or share, what you're doing is you're owning a small part of that company. It's also known as an equity. That's another term that people use. Investing is not a quick fix. It's slow, it's steady, it's long term. So when you're investing, you're looking at putting your money in for 5, probably 10 years is best. Now, the other thing that people can get confused with is the difference between investing and trading. So investing is for the long term, trading is much more short term. It's maybe something that you do every day, every week, every month. And what you're doing is you're buying and selling things, for example, stocks and shares or foreign commodities, and you're hoping to make a profit in the short term. Now, I don't do trading. And what I see from trading is that you have to really know what you're doing. There's a lot of kind of technical stuff that you need to know. But the reason you put energy and time into trading is because they're hoping for a better and faster return than the stock market. So investing, why do you want to do it? So the thing about investing, about having an asset, is that you're having your money working for you. So time is very limited. Our time is very limited. The amount that we're paid is often not as much as we would want. So by investing, you're having these assets and they are creating wealth for you alongside your work or your business. And it is really important that we take this step to take charge of our financial future, because if we're under 50, we can't, and even if we're over 50, we can't rely on the government to provide us with a pension or our financial future once we get to that age. Yet at the same time, there's also been no better time to learn about investing, become an investor. It used to be that you used to have large amounts of money to invest, and you had to ring up your stockbroker in the city, and it was a very sort of exclusive club. But the internet has democratized investment and made it accessible. You can start small, you can start simple. And the great thing is that if it's your money, you're going to be most interested in it. So you are in a very good place to invest in the stock market yourself. So the other thing that's really important as women to be aware of in terms of investing is this thing called the investing gap. So this is a statistic from the Pensions Policy Institute in July 2019, which was looking at the average of what the average pension for a woman and a man retiring at the age of 60. Now, I know a lot of us retire later now, but it's a huge amount. And this is for various reasons, which we're all familiar with. You know, often we're part-time working, we're caring, we've got caring responsibilities. There's the still, and often we're responsible for childcare costs, but we also live longer. So this is a big problem, and this is something that is really important to address and take charge of in terms of our own financial future. So what I'm going to go do now is to go through 3 simple investing ideas. So I was saying earlier, sometimes people think they need to know a lot about, well, you need to be good with numbers to invest. You don't. You just need to understand a few simple principles, and then you'll be absolutely fine. So the first one is what I like to call the magic of compounding. So this is as something which Einstein described as the 8th wonder of the world. So he who understands it earns it, he who doesn't pays it. So it doesn't sound that exciting. So these, now if you're filling out your sheets, this is when you need to fill something out, because this is when it's on your on the questionnaire. So compounding is basically when the money that you make makes more money. So in this very simple example, I've put in, so say you're going to invest £1,000 and you put it into a very low cost, low risk investment, and you get a 5% return from it. So at the end of your first year, you've got £1,050, which is great. Then the next year, year 2, you get another 5% on your £1,050, which makes at the end of year 2, £1,103. Now, if you leave that compounding away and you don't do anything for the next 20 years, you've got £2,653 and you haven't done anything. So that's £1,653 for nothing. So this is why compounding is a force that you want to harness. What you can then do, though, is you can harness that even more by adding money in every month. So say, for example, you got your £1,000, you said, okay, I'm going to put in another £100 every month, invest another £100, which would be £1,200 every year. You times that by your 5%. At the end of year 1, you've got £2,310. Again, year 2, you take your £2,310, you add another £1,200, it compounds at 5%, you have £3,686. So if you just leave that money compounding away, you're adding in £100 every month, by the end of 10 years, you've got £17,000, 477. At the end of year 20, you've got £44,316. So what you've done in that time is that you've made £19,000, 316 for nothing. You haven't done anything apart from at the beginning make some very clear, conscious money choices. And you get that amount of money by taking away the amounts that you put in at the first time. So this is a force. This is a force that you want to have working for you. Now, with an asset, compounding is working on your side. It's creating wealth for you. But with a liability, so something like a credit card debt, and the average, I think the APR on a credit cards is about 18%, that compounding will be working against you. And if you've ever had credit card debt, you know how difficult it is to, you know, you're paying off the capital amount, but then you're also paying off the interest, and it's a huge amount of money. So this is why it's good to start investing as soon as you can. It's also really good if you can invest on behalf of your children or your nieces or your nephews, because then there's that longer space of time that they can have compounding to work for them. So I love it, for example, when clients of mine tell me that they've teaching their daughters and sons to invest, because that's, then they've got that extra bonus of time on their side. So the second thing, the second kind of principle behind investing is inflation. So inflation, which I'm sure you're all familiar with, is the rate at which prices for goods and services increase. And what inflation does is it means that we can buy less with our money and we feel poorer. So a good example of inflation in terms of a practical example is things like Toblerones and crisps. So I don't know if you've noticed, but the price of crisps has gone up, and the packets have got smaller. And then Toblerones, there was a big hoo-ha not that long ago because they were increasing the distance between the triangles of chocolate. So what they were doing is they were charging you the same, but they were giving you less chocolate for your money. So that's a more quirky example of inflation. So the current inflation rate at the moment is 0.7%. So we have very low inflation rates at the moment. Now, there are some people that argue that actually the real rate of inflation is much higher because the way that inflation is measured doesn't take into account key sort of commodities, key ways of measuring how prices are increasing that reflects truly how the value of things are priced and serviced. So there's a book called How to Run the World by Andrew Craig, and he says that the inflation adjusted wage of the average UK or USA citizen hasn't increased since 1973. Now, I don't know whether that's accurate or not, but that's that feeling of like, inflation means that we feel poorer. We're not being able to buy as much for our goods and services. But the other point he makes is that the economy, the world economy, and obviously there's been a bit of a blip with the pandemic, keeps on growing. So from 32 to $74 billion in the last 10 years. And it will continue to grow. So this is why it's important that when you're investing, what you're doing is you're owning some of that growth in the world economy. So the other interesting thing about inflation is that if you're leaving your money in a savings account, you haven't got to invest it in a savings account, the rate of inflation that you will receive is unlikely to be more than the current rate of inflation. So, I mean, I just Googled today, what were the best, savings account and the rate of inflation, and generally they're lower than 0.7%. So this means if you put a big chunk of money or even a small chunk of money in a savings account, it's not even keeping value with inflation. So that you are in a way risking your money by doing that. So then the last kind of principle we're just going to look at with investing is this thing called risk. So as I was saying, people say about investing, it's risky and you'll lose everything. That's the kind of fear about investing. So I've just got here a quite nice, it's a little bit out of date graph from the Financial Times, and it's just looking at the FTSE All Share Index. So an index is something that measures the overall value of all the stocks and shares on the UK stock market. And this graph shows how that has grown over time. So you can see, it goes up and down quite a lot. So this sort of first high bubble in the middle of the screen, that was something called Black Monday. So there was a big storm on the Friday, and then the stock market opened on the Monday or the Tuesday, and there was this great fall in the stock market. And then this one at the top here is the so-called dot-com boom and bust. So this is like at the early 2000s, where loads of people were putting money into dot-com companies. They were, it was the birth of the internet, and then there was huge amounts of money going in, only to find that actually there wasn't anything behind these companies, and there was this massive great fall in the stock market. And then on the far right hand side, you can see the latest sort of financial crash of 2008 started off by the problems in America with the so-called subprime. Again, the stock market fell, but you can also see that after a fall, the stock market does bounce back. And in general, not all, but in general, this is what your stock markets do. And this underlying growth, this is what you're wanting to harness. This is the compounding that you're wanting to harness by investing your money. So this is a more recent little graph showing the stock market, and this in this sort of big fall, sort of after 2020. This is the result of the pandemic. So you know, there was a huge, great fall in the stock market. It lost like 30% in a very short amount of time. But you can see that it has bounced back. Now the UK stock market is, you know, it's not where it was last year. It lost 9%. But if you'd invested in America, the stock market in America went up 18%. So this is just to demonstrate that when you invest, I mean, what financial disclaimers always say, so you have to expect your investments will go up and down and blah, blah. The thing is, they will go down. I mean, they will, and you just won't like it. And I know this from experience. And there is behavioural research that that shows that we feel far more discomfort and pain and annoyance when the value of our investments go down than we feel happy or joyful when the value of them go up. And I can definitely, from my own experience, I definitely can testify to that. But I think the thing is, if you're being a successful investor, what you have to do is not take those falls personal and just keep calm and carry on investing. Okay, is everybody okay so far? Does anybody have any questions? Just everybody all right?
There's no questions yet, actually.
Okay, great, brilliant. Okay, so when to invest? So the thing is about investing, and this is what I learned from my dad, is that you never want to invest money that you can't afford to lose. So it's a very good idea before you start to have certain things in place. So the first thing is to have £1,000 in a savings account somewhere for expected, unexpected events. We all have expected, unexpected events, like, I don't know, we've got to take the cat to the vet, or the dishwasher blows up, or we need a new printer or print cartridges. I mean, that's actually sort of standard, that's not unexpected. But so you've just got that money there, and it can handle those kinds of things for you as and when they come up. Then what you want to do is to put aside something called a cash safety net. So this is your basic living costs. So your basic food, you know, your rent or your mortgage, all your sort of bills, you know, a bit of money for enjoying yourself, but you're, you know, quite an austere amount of, you know, living costs. And then you multiply that between 3 to 9 months, depending on your level of sort of risk and what you'll feel happy with. So that means if there is something like you lose your job, or I mean, the last year was a very good example in terms of the pandemic, you have got money there to protect and provide for you. Then the other thing that's very important is to pay off expensive consumer debt. So as I was saying, if you've got credit card debt, that is just really eating away at your wealth, really, and you want to be paying that off as soon as possible. So once you've got those things set up, sorry, and just before that, this is quite a good way to allocate your income to kind of cover those different aspects of your life. So this is something called dividing your money in things called wealth pots. So what you do is you allocate a certain percentage of your money to different aspects of your life, and then you've got it all covered. So this is looking at your income after tax. So they're basically 6 wealth pots. So the first one is your financial independence. So this is putting aside 10%, more if you can, at least 10% into investing or creating wealth in the future, into assets. Then 10% of your income is for your save to spend. So remember, this is the difference between financial independence is investing, saving to spend is spending. So this is money you are going to spend and not until later. Then education. So this is very important. This is about investing in your education. So this course would count as one of those, that anything that is going to further your growth and development as a person, because of course you are actually a very important asset, and it's very important to invest in yourself. Then the next pot is your play pot. So it's very important that we let our money nurture us, support us, and we have fun for it. It's not all about skimping and saving and not enjoying it. So your play pot, you can spend on whatever you like. I had quite a tricky time at this one at the first time, but now I'm much better at it. So it could be going out, it could be, I don't know, having your nails done, it could be clothes, that could be a necessity. So anything that you feel is like a treat or something special for you. Then the idea is that you live off your necessities covers your living costs. So this is covering all your basic living costs, your food, your travel, all of those things. Now, this isn't easy, especially in London. And what you can do, once you have an idea of what they are, is look at where you might be able to have cut things so that you're living on 55% of your income. Then the last 5% is your contribution. So this is what you're giving back. It could be giving back to charity causes that you think worthwhile. Now, for some people, I did this while I didn't actually give money, I gave time. So that might be another way that you make a contribution, but it's all about giving, giving your money. So the other thing about investing, before you start investing, is to be clear, is what kind of financial goals you have. Because as I said earlier, you don't want to be investing money that you're going to be needing in sort of, 3 to 5 years. And the reason for that is sometimes people ask me, that maybe they've sold their house and they're waiting to buy another home, and they're saying this money is just sitting in my account and it's not doing anything, and they're sort of feeling like it's not, it's sort of wasted. The thing is, if they're then going to buy another home in 6 months, a year or 2 years, you don't want to be investing that money because of the ups and downs in the stock market. If you plopped it into the stock market just before the pandemic, and then there was that massive great fall, and then you needed that money to buy a house, that would have been terrible. So you want to be clear what your goals are and the financial implication of those for the next immediate, short term, medium and long term. So you're not putting that money in your investing. So then you would save, your savings pot would be towards those things. That's what you would do your save to spend pot for. So how do you start? So I'm now going to go through as what I call my 7 simple steps to successful investing. I go through this in a lot more detail when I'm working with one-to-one clients, and I can't go into all the detail, and I'll go into as much as I can in the time we have. So the first step is investing in your financial education, and that's very important. That's what you're doing by being here today. And this is, I think this is maybe the most difficult part of investing, is making up your mind you're going to learn about how to do it. And it doesn't need to be a huge amount of time. I'm a great believer in sort of starting small and being consistent. It might be that you attend one event a month, or you decide to read an article a day, or put aside 20 minutes each day for your financial education. It is amazing what you can do in that amount of time. And I personally do still have to work at this. I have never skipped over to my computer to sort out my investments. Every time it's I have to use all my discipline to do it. And it's the same with learning about money as well. It's not something that becomes particularly easy for me. So invest in your financial education. You have started that because you're here, so that's great. So the second thing is that you need to choose where you're going to invest your money. So you either need to choose a person or a platform. So a person would be like an independent financial advisor or a financial planner. And what they would do is that they will sit you down and they'll go through in a lot of detail about your income and your expenditure and your financial goals. And they'll make recommendations of how and what you should invest with, and then they'll charge you a percentage fee for that. Now you're here to learn how to invest in the stock market yourself. So the other 2 things that you can do in doing it yourself is you can either use a robo-advisor or an online broker. So robo-advisors are relatively recent things. So a name, you may have seen it on the tube, something like Nutmeg or Wealthify, something like Pension Bee, that's one of them. So these are digital platforms, and they provide automated investment services with little or no human supervision or interaction. And so what you can do is you can go onto them, you fill in a few facts about how much you want to start with and how much you want to add in per month and the type of investor you are, and then they suggest a sort of ready-made portfolio. And I think for Nutmeg, they've got like 4 different options. So they've got a limited number of choices you can make, but that can be really good because it's simple. And you can start with very little, you can start with £1 if you want to. And then the other way you can invest is using an online broker. So online brokers are like banks, but for investing. And they're also banks who also do investing. So for example, Barclays, definitely do it, NatWest, people like that, but also other online brokers. You might have heard of a company called Hargreaves Lansdown or Fidelity. They are also online brokers. And what they offer is so you have the difference between a broker and a robo-advisor. You have a lot more choice about what you can invest in. You can also buy individual stocks and shares if you want to. You can buy funds. You can buy all kinds of things, and they'll charge you like a percentage. They'll charge you a percentage fee. So you do need to do a little bit more research with that. So then the third thing you need to do is to choose a tax efficient pot. Now on your notes, I have put a bit of detail about this because this can get a bit confusing, but I will go through them and make it as simple as possible. So there's basically 4 different ways to do this in the UK. And the UK, actually, we're really lucky. Most people don't realise these kind of opportunities that we have to invest in a tax efficient way. Lots of countries don't have this, or it's a lot more complicated, like Ireland, for example. So the first possibility is something called a stocks and shares ISA. So an ISA is an individual savings account, and you can have cash ISAs. You might have a cash ISA, and you can have stocks and shares ISA. So a cash ISA, you'll put the money in, you'll get paid a very low rate of interest, but you're not charged. You don't get taxed on the interest you receive. A stocks and shares ISA, you put your money in and then you can use it to invest in the stock market. Now you can put funds into your ISA every year. You can take the money out when you want. And what's brilliant about an ISA is that the money that you create within that is tax-free. So you don't have to fill in a tax return. It's tax-free. I mean, it's brilliant. So that's the first way of doing it, stocks and shares ISA, and you can invest your £20,000 across the cash stocks and shares ISA, the cash ISA and the stocks and shares ISA, and you can only open one ISA per year. Then the other way we have of investing is through a pension. Now, some of you, you may have a pension already, like you've been had a pension through your work. So actually, you're already invested because you have a pension. So these can either be through your work, or they can be ones that you set up yourself. So a workplace pension, and employees have to do this now, they will set up a pension for you, and then they contribute a certain percentage, and then you contribute a certain percentage. And then you'll have a range of options of how you can invest that money. So if you're offered a workplace pension, it's a really good idea to take it because your employer's contribution is in effect money for free. And then the other way of doing that is a self-invested personal pension. So this is something you open up yourself, you put your money in, and the difference between this and an ISA is that once you put your money in, you can't take it out until you're 55. Now, the money that you create within that, with your investments, is also tax-free, but when you take the money out, the first you can take 25% out once you reach 25, that's tax-free, and then after that you're taxed as if it's income tax. So those are the difference between the two things. Now, if you are between the ages of 18 and 39, you might want to look at something called a stocks and shares lifetime ISA. So Now, this ISA has to be used to buy your first home, has to be the first home, or it's towards your pension. And you can put up to £4,000 into this, and then the government will give you 25% sort of tax break on it. So they'll top it up to £5,000. So so that's worth worth looking into if you fit into that age bracket. And then the last way of investing in a tax efficient way is a junior stocks and shares ISA. So this is if you this is what you would open for children under 18, and you can put into up to £9,000 in that, and then you can invest it on their behalf. So sometimes people open this for their kids, open this for their children, and then they practice their investing on their children's money, because there's a lot longer time, it's a sort of experiment, and then once they're 18, that money becomes them. It could be something to finance their education, or maybe money towards their home, something like that. So that's another way of doing it in a tax efficient way. So I'm just showing you now a really good website called boringmoney.co.uk, and they have some really good resources there for choosing a provider for either an ISA or a pension. And you sort of fill in a few things. You can see here about how much you want to put in, how complicated, and then you have a few other options about whether you want the investing to be cheap or green, and then they'll make some suggestions about different platforms or robo-advisors that you can use, and then all their their recommendations come from user reviews. So that's a really good resource. I mean, they've got loads of other stuff there as well, so I would definitely look them up. So once you've opened your account, your tax efficient account, you need to put some money into it. Now you can either pay in a lump sum, or you can pay in a regular amount every month. It's good if you can do both, but and this can, I mean, robo-advisors, you can start with £1. Generally with online brokers, you can start with regular investments of like £25 a month. And as I was saying before, it's a good wealth habit to get into of 10% of your net income into your financial future, your financial independence. So then you've got your account, you put your money in, then you need to buy something with that money. Often people think that their money's in there and that's it, invested. It's not. You have to go like shopping for investments. You have to buy something. Now, if you're just starting investing, then the best thing you want to do is you want to do something called passive investing. So passive investors, so passive investments, are these things called index trackers. So I'm just going to go back to my chart on, okay, here we are. So we talked earlier about what an index is, and what you can do is you can buy these investment funds, tracker funds, and what they do is that they follow what the stock market does. So say you opened your account and you put in £1,000 and you bought an index tracker that was following the FTSE All Share. So what that would do, what that money would go into a fund, a basket, and then that money would be used to buy 500 or 600 shares on the UK stock market. And so what you're aiming to do by that is just follow what the stock market does and harness the underlying growth of the stock market. And the great thing about index trackers is that they're low cost, and they're also low risk, because what you're doing is you're spreading your risk amongst a huge basket of shares. So amongst the stock market, there might be one or two companies who are doing really great and some companies are not doing so great, but you're using this thing called diversifying. You're diversifying your investment, so you're not so it's less risky, basically, and then you're harnessing the underlying growth of this particular index. Let's just go back. And the thing, so this is what passive investing is. So it's low cost, low risk index trackers. And they're not managed by people, they're run by computers. So there's that consistency about them. And there's lots of research that shows that generally those funds that are managed by people, by managers, by fund managers who have salaries and bonuses and things like that, do less well than those which are run by a computer. So Warren Buffett, who's a very, very successful investor, has said that when he pops his clogs, he wants Mrs. Buffett to put her investing, his money, into index trackers. He doesn't want her to do it herself or anybody else to do it. He wants it to put the money into there. And then you can buy index trackers, you can buy these types of investments, all kinds of ones. I mean, you can buy them to cover different types of investments, like sort of property or commodities. You can buy them in different parts of the world, you know, like the UK or Europe or the USA or, you know, Asia. So the idea is that you buy a selection of these, and then you're spreading your risk across the stock market. So, for example, I think I said this, the stock market in the UK last year went down 9%. The American stock market went up 18%. I think Japan was something like 15%. So if you've got a selection of index trackers following different countries, then you're spreading your risk rather than putting them all in a few stocks and shares in one country. So the other thing that you can do as an investor is you can have an awareness and make choices about where you want your money to go in alignment with your values. So this has got various names. It's called sustainable investing, responsible investing, ESG investing, which stands for environmental, social, or governance. And generally, the idea behind this is that you're avoiding putting your money into businesses which aren't looking after the people or the planet, or not sort of following proper processes, or not treating their staff properly. Now, it used to be a very niche thing to do this type of investing, but now it's not. I mean, I've got some figures here. So in 2013, less than $2 trillion was invested sustainably. By 2019, this had rocketed to a total of more than 31 trillion. So now around 25% of all investing funds consider sustainability. So it's a massive shift, which I think is really important. The thing is to be careful and to read the small print, because, for example, BP, they're a big company, they're taking oil and gas out of the ground, which might not be your thing. They do feature in some of these ESG funds because they score really well on the governance, how they treat their staff, how they govern things. There's another fund, it's just, I mean, I've got this note here, LNG Future World ESG Index, also supposed to be, you know, sustainable, responsible, but they've got 11% of their money invested in tobacco, alcohol, gaming, and defence. So there can be quite a lot of greenwash around, and you need to read the small print. But I think one of the things that you can do very simply if you have a pension is you can look at what your pension is invested in. So a lot of us have pensions and we're accidentally investing in things that we might not agree with. I mean, there's a campaign at the moment called Make My Money Matter. And so they're looking at the £3 trillion worth that is investing in UK pensions, and asking people to just investigate what that's invested in. And then you can make choices about where you want your money to go. Now, some people, for example, I don't want to be investing in things that are taking oil and gas out of the ground. For other people, it might be to do with, like I had one client, she didn't want any companies to do with tobacco and smoking, because her father died of lung cancer. So you can, you know, it's something that requires a little bit of work, but you can put your money into things which you feel are kind of congruent, have integrity, which I think is important. So the other thing about investing, step 6, is you have to just leave it alone. So the big problem with investing is that people want to make it far more complicated than it is. So once you've set yourself up, you've got your investments, you've got your money in, no fiddling, tweaking, taking money out, panicking, selling it, all that stuff. You can look at it, but don't fiddle with it, because you're investing in the long term. So boring is best. And I think that's a bit of a problem with investing sometimes, is that actually the most successful investors they're just plodding along, doing the same thing, you know, month in, month out. They're not buying very sexy or kind of hot shares. So the thing about investing, I think, because it is a bit dull, people are always looking for stories, you know, they're always looking for the latest thing to invest in. And often people, you know, they ask me about this or that, or they give recommendations about this or that. And I always smile sweetly and I completely ignore them. So yeah, slow and steady, boring is best. That is actually, investing is more about your qualities as a person than than what you know about investing. And that is what I found is really about. It's about consistency and it's about discipline. Oh, and the last step of a course is to celebrate your successes. So lots of my clients always talk about having bottles of champagne when they've made their first investment. So this is really, you know, this is really important. You open your account, you put some money in, you've made an investment, you know, have a celebration. That is really, really important. So the other thing to know as a woman is that you are statistically going to be better at investing. So there was a report from the Warwick Business School in 2018 looking at the performance of male and female investors over time. And they found that we outperformed men at investing by 1.8%, which doesn't sound that much, but if you compound that away, it can make a massive difference. And this is for several reasons. So the first thing is that we are more risk conscious. I mean, the thing about women is that we want to understand investing before we do it. And often because it's so opaque, full of jargon, it just looks so boring, you know, that really gets in the way. But once we do it, we understand it, we do it, we're great. And we are aware, because we're understanding it, of the risk that we're taking. We're more conscious about that. The other thing that we do, which means enhances our performance, is that we more buy and hold. So investing is buying and holding, as I told you, rather than trading. So the point that often men lose money is when the stock market is coming down and then they panic and then they sell. Whereas in general, women are just buying and holding, carrying on with their strategy, and that's really sensible. We spread our risk as well, so we diversify, and we're thinking of the long term. So generally, women, when I ask them about what they're investing for, it's not really about the money or the returns it's really about what that money can give us in terms of freedom and choice and space and time. And that's certainly been my experience of investing, of what that's given me, and also why I aspire to do it. I wanted choice about how I spended my time, and I didn't want to be a wage slave as an architect. Okay, so just to summarize then about starting your investing. So start small, start simple, and start now. So invest in your financial education, and that can also be small. Choose a person or a platform. Choose a tax efficient pot. Put some money in. Buy something with it. So you're buying low cost, low risk index trackers, and choose them in alignment with your values. If that's important to you, it might not be. I mean, some people, you know, they want to, another way of looking at it is saying, well, I want to make as much money as I can, and then I can give that money to charity. But it seems to be, I've found for most women, they do have values that they want to invest in alignment with. Leave it alone to grow. Just leave it alone. Don't twiddle or tweak, just leave it alone, and then celebrate your successes. So I have put at the end of the sheet, and you may not be able to think of this straight away, about, you know, from today, you know, what's one thing you can do this week towards becoming an investor? You know, what can you see that is, you know, your next step? And it might not actually be investing money. It might just be actually finding out more about things, or finding out what you've got, or doing some research. So you might want to write that down on your sheet now. I can see everyone's scribbling, might be writing notes. I can see Casey's writing down something. putting out a thumbs up. So then before I go into some questions, am I all right for time, Caroline? Am I doing the right kind of, yeah, okay, great then. I'll just run briefly through how I do work with people, because from today, you know, I hope and trust that you'll be able to go away and start investing. But I also know from my own experience of working with my dad, well, not working with him, but having him by my side, that I had someone that I could ring up and ask questions about, and it was somebody that I can trust. So I do work with people on a one-to-one basis, in terms of taking you from being like a quivering on the edge of the pool kind of investor to being confident and knowledgeable about what you're doing, being fearless basically. And the idea is to make it as simple as possible, simple and automatic, so you can get on with your life. As I would say, to do it in a few hours and then go dancing. So when I worked with people on a one-to-one basis, we cover a lot of what we've done today in a lot more detail. So we look at your purpose and your goals of investing, like what are you aiming for? What's the purpose? Where do you want to be with your money and your wealth in the long term? We go into a lot more detail about the principles of investing, and particularly compounding, and what this thing about financial freedom or independence is and what that means for you, because it's different for different people. We look at sort of your wealth habits, you know, the money that you're saving, the money that you're investing, getting on top of, you know, your sort of day-to-day money and your wealth pots. And then we go through in lots more detail, the 7 steps to simple, successful investing, so that you've opened an account, you've put some money in, and you're clear about what you're going to buy with it that is in alignment with your values, and doing that all in a way that is kind of focusing on being consistent and disciplined about it. And then the other thing about investing is that once you've started, it's like, how do you keep going? How do you get yourself back on your computer and keep going with your investing? So we cover all that when I work with people one-to-one. And so what that is, it's 4 sessions of 1.5 hours each, and it's tailored specifically to your financial situation. I've got lots of handy notes that got lots of lovely women looking glamorous in the 1940s. There were recordings, and of course I'm available to ask questions before, after and during as well, making it all jargon-free and sparkly. So normally that costs, I charge £649 for that. And here are some testimonials of people that you might know, actually. So this is from Denise. So she said, since the training, I've started to invest in the stock market and have a renewed sense of financial empowerment. It was clear and easy, busting the myth that stocks and shares is complicated and exclusive. And this is from Vivian, who's a journalist and coach. A fantastic introduction to investing. I haven't looked back. Elizabeth made the stock market and investing simple and fun, which is no mean feat. I then went away and became a confident, regular investor. So today, as you're here at this taster class, I'm offering how I normally work with people for £549, which is a 15% discount. If you would like to take me up on this and work together, which would be great, please email me by the end of tomorrow. I've got 77th of May there, that's a typo, 7th of May. And then I'll ask you to pay a deposit by the 13th of May, and then the balance before we start on our first session. I do offer people a guarantee, so if for any reason you feel at the end of it you haven't got the knowledge and confidence that you want, then please ask me for a guarantee. I'll give that back, no questions asked. Yeah, and then just a reminder, so that would £549 gives you 4 one-to-one sessions tailored to where you are with your financial at the moment. Lots of links, materials, recordings, and support to make the choice. So you have that experience of being financially empowered and taking charge of your financial future. So email me by tomorrow. And then please do ask me any questions, and I'm going to stop sharing now.
Excellent. Thank you so much, Elizabeth. And don't worry, everyone, I will be sharing that offer in the post-event email anyway, so don't panic if you haven't written that all down. Right, so lots of questions, which is great. So have you ever heard of Beanstalk? Veronica is looking at the possibility of setting up accounts for her children and possibly for herself, ISA savings as well as stocks and shares. Their fee is £20 per year. And she's just wondering what is the best value, use Beanstalk or go direct to the people dealing with this?
Oh, no, I'm afraid I haven't heard of Beanstalk. Maybe you could tell me. No, I haven't. Are they a bank or a Caroline?
So Veronica, do you want to come off mute?
Oh, Veronica,
You
yeah.
can explain what you mean.
Yeah.
I've only just come across them the other day, so I can't really say much, but I believe that they are sort of taking the hassle out and making an umbrella platform.
Okay.
You have an app on your phone and you can just go from one account and swap you can go from the savings or stocks and shares, just change the percentage whenever you want. Right. It's just very, very easy, but I'm just wondering if it's the best. It's easy can sometimes be quite tempting.
Yeah, apologies, they're so new, I've never even heard of them. So no, I don't. I think with these apps and also the online brokers, if it's easy to use and you understand it, then that's great. I mean, I think that's good. With online brokers and also with apps, well, particularly with online brokers, what I often say to people is call them up as well. So if you call them up and have a conversation with them, and they can explain very clearly to you how to use it. I mean, I don't know whether that's available on this particular thing. Then that is also a good sign, because if they've got, I don't know, I've like called Fidelity and Hargreaves Lansdown on behalf of people, and they've just taught me through things on behalf of people very simply. I mean, it depends how you like to get support in your life, I suppose. Yeah. I'm more of a talking person rather than a chat person. So, but if you feel it's easy to you and it's clear to you, then that's probably the most important thing. But I'm afraid I don't know about Beanstalk.
That's fine. I'll look into it more.
You're ahead of the game. Yeah.
Excellent. So Casey asks,
yes.
Both her daughters have got ISAs from the government when they were born, and she's always been worried about adding to it, as it would be their college funds. But she now realises that she's had their money in rubbish accounts that do nothing at all. As far as she's aware, you can't withdraw from these accounts until they're 18. So would you recommend putting a percentage into those to boost them up a bit?
Can you invest them, Casey? Is it like a stocks and shares ISA?
I think there's two choices. See, I've kind of like just put the letters to the side.
They're probably really dull letters. They're probably really dull letters, aren't they? Yeah.
I think you've got a choice. There's ones where you can, you can risk it, or there's ones where you can kind of just have it sitting as it is. And I've just literally left them, which is probably not, looking back, probably not the best. But actually, we needed access to their money over the time, so that's why we did it, I suppose. But now that we're kind of in a better situation, I kind of want to move towards, teaching them a little bit, learning themselves, so that they can, because they're in a position now, they're 17 and 12. I want them to be able to, mess with this money for the next, what is it, another 10 years before everything kind of, it's found there.
I think, I don't know, I just think that those junior ISAs firstly,
because they don't get them anymore. These was when they were born, they were given them, but they don't, get them anymore. So I kind of, want to make something of them if I can. Willow's only got another 6 months, I think, on hers.
Yeah.
But Inara has got, another 6 years. So.
Yeah. Well, I suppose it depends how essential that money is. I mean, but if you want to use it because the thing is, if you're teaching them how to invest, you're going to have to kind of learn yourself as well. Exactly. And I think to be able to do it together would be great. Obviously, you have to, the money might not necessarily at the end but I mean, if you could teach them to invest and then they leave that money there, the compounding on, from, I think I remember having somebody brought their daughter to one of my classes, and we worked, she started investing. We worked out she was going to be like a millionaire by the age she was 30, because your children have got time on their side,
Exactly. Yeah. That's kind of what
but if you did that together as a project, that would probably make you do it as well, because it's their financial future.
Exactly. Yeah.
And I think probably you can have them as cash, and then you can also have the stocks and shares one as well. So
okay, cool.
Yeah. Does that help?
Yeah, definitely. And I've got loads of notes written down.
Good.
Oh yes, good. Exciting times.
Okay, great.
Thank you.
Excellent. Thank you. So Sarah says, you talked about investing in wine, property, etc., as well as in shares.
Yeah.
Can you talk about the different tax implications?
Oh, no, I can't. No, I can't. I know something about tax for, well, I do know something about for investing, but I can't talk about those other things. I just use those as examples of, other kind of assets, but I'm not, I'm not a tax expert. I'm sorry.
Don't worry.
I'm sorry. Oh, no.
No, it's very specialist area.
That would be a bad idea for you.
Yeah, I think it's probably best.
Sorry, I can't help.
If you're not entirely comfortable with that one.
Yeah.
Sorry, if I can just respond to that. It's not specifically whether putting your money into art or wine, whatever. It's just that actually to understand that there is a different tax implication whether you're going down the stock market route or you're going to real assets. Do you see what I mean?
No, I'm sorry, I don't.
Yeah.
Sorry.
Okay. So that actually there are some assets will be subject to capital gains, others won't. That was the point I was trying to get to.
Oh, I see. Okay. Well, if you're investing, the only time you're subject to capital gains is if you, so we talked about tax efficient accounts. So there's 4 options. You can also set up something called generally it's called like a general investing account. And that would be subject. So some people, for example, they use up their £20,000 ISA allowance, they use up their £40,000 SIP allowance, and then they've still got more money to invest. So they might then put that into a general investing account, and then that is subject to capital gains. Is that what you're saying? Sorry, I don't know whether I've understood that properly.
Yes, that's okay.
Okay, great. Next question. Kanan asks, is cryptocurrency considered investing or more for trading?
Well, this is my personal opinion. I think it is an investment, but it's a very speculative investment. So it's very volatile. It's very speculative. So, like 3 years ago, loads of people were investing in cryptos because the price had gone up and then it sank. And then at the moment, it's been one of those, hot topic, hot things because the value of it. So I personally, if you would say, it's very speculative. So maybe only have a very small percentage of your overall investing portfolio in cryptocurrencies, like 1 or 2%. It's quite opaque thing to do. But yes, it is an asset. It's an asset, but it's a very speculative asset. Yeah. Does that help?
Thank you. Do you get taxed on income generated through stocks and shares pensions when you withdraw them?
Sorry, say that again, Caroline. I just lost the middle sentence. So
Do you get taxed on income generated through a stocks and shares pension when you withdraw it?
Income generated. You mean like from dividends?
Natasha. So Natasha, you want to come off mute?
Yeah, sorry, Natasha. Maybe you could just clarify that. Hello, Natasha.
Natasha, maybe she's not there. Yeah, this is not something I really understand either. Do you get taxed on income generated through a stocks and shares pension when you withdraw it?
I don't really understand that question, I'm afraid.
Okay, well, if she pops back, we can.
Yes, that would be great. Yeah.
Clarify. So Lucy has asked, how can you invest in American index trackers from the UK? Do you have to use something or someone like Hargreaves, or can you use a robo-advisor?
Well, you can do it. You can do it through both, really. So you can do an online broker. So if you go onto a robo-advisor, what they'll do is they'll give you, like, maybe, for example, 4 options of investing. And then within those options, you can see what they're invested in. And some of them within that sort of basket of options, it'll include an index tracker that's an American index tracker. So if you went onto Hargreaves Lansdown, you could just sort of put in, USA index tracker, and then it would give you some options. So you would buy that individually. If you used a robo-advisor, it would be packaged up within within one, say, of their 4 investment options on that platform. Does that make sense, Lucy?
Not sure if she's there live or just recording it.
Okay,
anyway, yes, thank you. Yes. Okay, fabulous. Thanks, Lucy.
Okay, great. Okay, great. Thanks, Lucy.
So those are the only questions we've had in so far. Is there anything else that anyone would like to ask? Feel free just to come off mute and ask it yourself if you'd like to. Lots of lovely feedback. Thank you for a really clear summary. Where was the other one? Thank you, well explained, and I'm really enjoying it. So well done, Elizabeth, that's great. So unless there's any other questions, I think we can say thank you to you and hand back to Sarah.
Thank you. I'm just going to share the screen when we've got Elizabeth's contact information. There we go. Forgot to do that just now. It looked like there was one question or something came in just now, Caroline. I can't see it. Just something, unless it was a thank you. Hang on. Interesting session. Thank you for the invite, and thank you very much for hosting. So yes, thank you very much for attending. I think, as Elizabeth said right at the beginning, you know, this is your first step. You know, well done for taking that first step towards your financial education, taking control. I think it's incredibly empowering, a session like this. It's about taking that control about your financial future, and as some of you have said, the beginning of helping your children to take that control as well. And I think that's incredibly important as we look forward, where we are going to have to take more and more control and more responsibility for providing for ourselves. And also, I think, as Elizabeth has pointed out, you know, it's fun. And I think that the subject of money is something that has always, you know, traditionally been wrapped up as too much jargon, you know, perhaps boring, you know, perhaps very male dominated. And so well done to each and every one of you for, you know, for attending and for taking this next step. Thank you for Elizabeth. I mean, the comments speak for themselves. You know, you set that out so in such a straightforward way, and thank you very much for introducing us to that. As we said to you at the beginning, we will send you a recording. Please do save the chat if you'd like to. To do that, you just click on the 3 little dots at the bottom of the chat box, and then you'll be able to also pick up on the links to be able to click on to really help the club, A, join us, and B, to find out about any other events that we've got coming up. And let me just leave you with this. I mean, this is, it's so interesting, the difference between investing, the difference between saving, and the difference between trading. And I hope what's really come across from Elizabeth today is that investing is about creating assets. It's about creating wealth for the long term for you, your family, and those that matter for you, and ultimately creating financial independence, which is something that's incredibly important to us all. And it's not just about what you know, but key to successful investing is consistency and discipline, and sometimes boring is best. Thank you very much for your time. We'll send you that recording, and do please feel free to leave the session. That brings it to conclusion. Thanks so much.
Thanks, everyone. Nice to see you.
Everybody, thank you for coming. Thank you. Bye.
Thank you. That was great. Thank you very much, Liz.
Thanks, Lizzie. Bye. Thanks, Sylvia.
Bye.
See you soon.